Hello and welcome to Options in Plain English. Today we're going to talk about how volatility affects option pricing by looking at Vega, which measures how an option price changes as volatility increases by 1 percentage point. A higher implied volatility will make options, both calls and puts, more valuable. This is because a higher implied volatility makes larger price swings more probable, and this is reflected in options' higher premiums. Volatility risk is a real risk that is unfortunately overlooked or misunderstood by many traders. When a trader is short options, an increase in implied volatility will make those short options much more valuable, generating losses that can rapidly grow as implied volatility keeps expanding. It is therefore very important that you understand how implied volatility can work in your favor when you're long options and how it can work against you when you're short options. Once you have identified this risk, you can incorporate it into your trading plan so you know how to manage it during the life of the trade. Ultimately, volatility is one of the most difficult to understand concepts for traders that are new to options but that are familiar with trading other instruments where volatility plays no role in their pricing, such as stocks or futures. It is important that you do, though, so that you can plan for it and look to profit from it as part of your trading methodology. We're going to start by looking at these Greeks and seeing what Vega does. We've already looked at delta, which measures how the option price changes as the underlying price changes. We've also looked at theta, which measures how the option price changes as time to expiration changes, and also how delta changes as the underlying price changes, which is gamma. In this case, we're going to be looking at how much the option price is going to change by as the implied volatility goes or changes by a 1 percentage point, which means if the implied volatility is 20% and the option price has certain premium attached to it, how much is this premium going to change if the implied volatility goes to 21? Keep in mind, we're not talking about a 1% of the implied volatility. We're talking about an increase of 1 percentage point or 100 basis points. Vega is represented by the Greek letter nu because it resembles a V, because Vega is not a Greek letter at all. It's just a name that option traders many years ago decided to give this risk measure, how much the option price changes as the implied volatility changes. So Vega measures the rate of change of the option price with respect to changes in the volatility of the underlying asset. Or in other words, how much will the option price change for every 1% or 100 basis points change in implied volatility, assuming nothing else changes. No changes to time to expiration, strike price, underlying price, dividends, interest rates. So we're going to freeze the other parameters. We're going to leave them the same. And we're going to push the implied volatility higher by 1%. And we're going to measure what happens to the premium of the option. As you can see, Vega is positive for long options and is negative for short options. So options are always going to benefit from a higher level of implied volatility. Why? This is because if you have a higher implied volatility, a large price swing is going to be more probable. Therefore, your option should be more valuable, and this is reflected in the option premium. If you're long options and implied volatility goes higher, then you're going to benefit no matter whether you have calls or puts. If you're short options, you're going to be affected negatively by implied volatility going higher and Vega acting on your position. If we analyze, and part of what we were talking about is, let's say you buy a call here. This is a long call. This is the at the money. You buy this call. Let's say it's a delta 30, for example. At this point, this option is priced based on this implied volatility. What happens if the implied volatility goes higher? Well, if the implied volatility goes higher, then this move making making this option go in the money is going to be more probable, because the swing, there's more volatility, there's more variation in the price that's expected over the life of the trade. So this is the reason why this dash line would be a little bit higher. Okay, so it will be over here, because now this call, once you bought it, you already have it, and then it goes higher, then that value that call has is going to be higher. And the opposite happens if you're short a call. So if you're short, you don't want this call getting in the money. So if you start the same, you are selling the 30 delta call, and implied volatility goes higher, then this move is going to be more probable, and the option is going to be priced higher. We've already talked about intrinsic value and extrinsic value. Intrinsic value only depends on the on where the stock price is, where the underlying price is with respect to the strike price. Extrinsic value is driven by implied volatility and time to expiration, meaning that if you have a higher implied volatility, you're going to have a higher value of extrinsic. And if you have longer time to expiration, you're also going to have a higher extrinsic value. Extrinsic value peaks right at the money, which is represented here, and then it's distributed in a way that's very similar to a normal distribution, basically peaking right at the money and then tapering off as you become out of the money or in the money. In this case, the actual shape of this distribution is log normal, but just to make it easier to understand, let's assume that it's symmetrical and that is a normal distribution. Now, if you have a higher value of implied volatility, that distribution is going to be pushed higher, is going to be shifted higher, so that, as you can see, this little mountain is going to be taller. Okay, same basic shape but taller. This is going to make this dotted line, which represents the value of the option. In this case, we're talking about a call. This is going to be further away from the intrinsic value, okay, because the extrinsic value is higher at every point. This is what we mean when we say that for both calls and puts, a higher implied volatility is going to bring more extrinsic value to the option, and this is what's going to drive the option price higher, or the option premium higher. Okay, so if you buy it, so basically an oversimplified or a simplistic way to look at this, but even though it might be simplistic, doesn't mean that it's not true. If you want to buy options and you buy an implied volatility that is low and could go higher, then you're in a better position than someone who is buying options where the implied volatility is already high. And although it could go higher, chances are it's going to be mean reverting, and it's going to go back to a mean over a period of time. So implied volatility determines how much extrinsic value you're going to have in your option. And when you want to buy it, it's better for you to look for a low implied volatility, because now if you buy low implied volatility, if the price doesn't go your way, but implied volatility does and it goes higher, you might be able to offset those losses or even have a profit, even though your directional outlook was incorrect. Okay, so when you buy it, you want it to be low, and of course the opposite applies when you want to short an option. You want to short options that have high implied volatility, and when you think that they might over time go down, because if it goes down, the price goes lower, and because you want to buy it lower than you sold it at, you're going to benefit from an eventual reversion to the mean for that implied volatility. Now, stock prices, underlying prices, are not mean reverting. You can have a stock that keeps going higher and higher, but implied volatility does display some characteristics of mean reversion. So you can assume that the implied volatility is going to eventually revert back to the mean. And what this means is if you have a very high implied volatility, you can assume that at some point it's going to go back down to the mean over a longer period. And same thing happens when you think about a low value of implied volatility. Over time, it's probably going to go higher. And this is especially important if you're looking to put on delta neutral positions. For example, if you buy a straddle, if you buy a strangle, or if you sell a straddle, or if you sell a strangle, where you don't care about direction and the only thing that you're betting on is the value or the total value of the options going down over time if you're short, or going higher over time if you're long. So what you want is you want time to pass and implied volatility to go down when you're short. And when you're long, you want the stock to move to either side, but in a violent way, or you want implied volatility to go higher. Both those factors are going to make you profit from your position. So we're going to take a look here at Vega, assuming there's no dividends and an interest rate of 0, because it makes the math much simpler. Vega, the formula is the standard normal distribution of D1 times the stock price, square root of time, divided by 100. So we have the same thing. New, this little symbol is Vega, standard normal distribution of D1. D1 is this. Is the natural logarithm of the stock price over K plus R, which is 0 in this case, plus sigma square over 2 multiplied by time divided by sigma square root of time. This standard normal distribution of D1, you're going to go over here to get this factor. And since this has this basic shape, you're going to have a very similar shape for Vega when we start analyzing the distribution of Vega. Okay, stock price, implied volatility, and time to expiration in years. We're dividing by 100 because we want to get how much Vega affects you for every 1% or 1 percentage point move. So if you look at Vega here, this is the basic distribution of Vega, and as we've done in the past, the green line represents a longer time to expiration, the black one less time to expiration, and the red one the least time to expiration. Okay, so when you have a long time to expiration, you have a lot of Vega. When you have less, you have the same basic shape. So notice how, unlike gamma and theta, which get somewhat skinnier and taller as opposed to fatter and shorter when you start with a long time to expiration. In this case, it's the same shape, just shrunken down. Okay, so you have the same shape. So as time passes, you have less and less and less implied volatility affecting the option premium. When you barely have any time left, the effect of implied volatility changing is very minimal. Okay, so unlike gamma and theta, which peak when there's very little time to expiration and when you're close to the at the money, in this case, the at the money portion is true, but when you have very little time to expiration, Vega is almost insignificant. So Vega works much more when you have a long time to expiration. Now let's go to our platform and take a look at an example with real data. So we're going to go to our trading platform, and we have Adobe right here. ADBE is a ticker symbol, and we can see that it's trading at $404. So we're going to open the July 2020 expiration with 32 days to expiration, and I would say that the at the money at 404, pretty much the at the money would be the 405 strike price. So what we're going to do is we're going to buy a call at the at the money with 32 days to go, and then we're going to sell the same call, same expiration, same strike price, same call. So let's start doing this. I'm going to buy the 405, and then I'm going to analyze it. I'm going to be paying $1,675 for a single contract. Okay, and then I'm going to come back, and I'm going to be selling the same one because of the bid-ask spread. Is going to be for a little bit less, $1,610. Okay, so I'm going to analyze it. We have here the price. Okay, and we have a value of Vega. So first, let's analyze the let's change the expiration here. So first, let's analyze the long call position. You have a Vega of almost 50 here, which means that if the implied volatility goes higher by 1 percentage point, you should be making $50 no matter what. Okay, so this is the stock price. I'm not going to be changing the stock price, but what I am going to be changing is I'm going to open up the padlock here so that you have the latest, the most current prices. But what you have here is the Vega is going to be acting on this, and there is a way here to simulate an increase in implied volatility. So the column that I want you to take a look at here as I start changing the implied volatility is going to be P&L open right here. Okay, so if you focus here, because of the bid-ask spread and how the theoretical value is obtained, right now I'm showing a $14 profit. So this is going to change as I start pushing implied volatility higher and lower. Okay, so what I'm going to do is right here, I'm going to adjust volatility by 1 percentage point. Focus here on the P&L open. Okay, I'm going to be pushing it higher by 1. So now we have $64 in profits, which means the 50 that Vega gave me are now reflected if the volatility goes higher by 1%. Now Vega doesn't change, it's still 50. Let's push the volatility higher by another percentage point. So now I have 114, pretty much the 50 extra dollars that Vega is giving me because I'm long the option. Okay, so as you can see, this is how Vega works here. Now I'm going to do the same thing. I'm gonna take it back to 0. Okay, go back to the beginning, and I'm going to analyze the short call, which is this, right? You have the initial premium, which is your max profit. It doesn't change. And then you have your start losing money as the price goes higher. If it hits your option strike price, is going to start losing money as it goes higher. Okay, so I'm going to do the same thing. I'm gonna increase the volatility. Okay, see how this position is already losing $80. Okay, so keep that in mind. I'm gonna push the implied volatility by 1%. Okay, Vega is minus 49.90. Okay, I'm gonna go higher by 1%. So a loss of $130. The price hasn't changed. It's the same price. Okay, in fact, let's freeze it here. The price is the same. Okay, it's only the implied volatility that's changing, and for a short position, it's a negative effect. Now let's go back to the long call. And now what I'm going to do is I'm going to go back to 0 in terms of volatility adjustment. This is the initial P&L that we have, and I'm going to now simulate volatility going down. We have Vega of 49.88, so I'm going to go down by 1%. So instead of 20, the 20 that we had, now we have minus 22. So this is Vega affecting the value of your long option, and it's going to affect it negatively. Now if I go another percentage point, now we have $77 in losses because volatility went lower. Now I'm going to do the same thing. I'm going to set it back to 0, and I'm going to go to the short call in this case. So now right now I'm showing a loss of $77, okay? But volatility is going to go down, and I have a Vega of minus 49, okay? So volatility starts going down, and now I have a loss of only $28. And if it's another percentage point, so that it goes down by 2%, now I have profits, okay? So you can see how Vega, negative Vega, which is what you have when you're short an option, in this case a call, but it's the same thing with a put. You can see how this affects the price of the option, and it affects your position depending on whether you're net short or net long options. Okay, the last thing that we're going to look at is we're going to pick in this case, the short call, the long call, excuse me, and we're going to take a look at Vega, and then I'm going to simulate the passage of time, okay? So you can see what happens to Vega. So in this case, focus on Vega and what happens to it, okay? I'm going to be speeding up the time passage. So I'm going to be simulating the passage of time, okay? See how Vega starts going down, down, down. Now, keep in mind, expiration is, I think, July 17th, I believe. So see how Vega starts going down, and it's almost going to hit 0 right here until it expires, and then you have 0, okay? So you can see how Vega depends on time to expiration, and also how it goes down as time passes, okay? So if you want to have a big exposure to Vega, you should have options that are that have a longer duration than the shorter durations that you should look for if you don't care about Vega, because in the shorter durations, Vega almost plays no part in the pricing of options. Okay, so this is what Vega is, and how important it is for your positions is reflected in the fact that when there's a market crash, for example, and implied volatility explodes, if you're short Vega, then you're gonna be negatively affected. And if you had positive deltas, the double whammy of having the price move against you, and also the implied volatility move against you, you can be looking at pretty substantial loss. So it's up to you to model and to look for a portfolio where your exposure to Vega, your exposure to implied volatility measured by Vega, is what you want it to be. If you want it to be neutral, then you have to be balanced. You have to be net short. You have to be net neutral, not neither long nor short options. Okay, so this is what happens when you start looking at Vega and how implied volatility affects your positions. Now, the reason why we looked at Vega as the last Greek doesn't mean that it's not important. It's just as important as the other three. Okay, and depending on the environment, it might be the most important. If implied volatility is not changing a lot, of course, Vega is not that important. But if it starts swinging between a high level of implied volatility and a low level of implied volatility, then Vega is going to be critical. So it depends on the environment. Okay. I would say without a doubt, delta is the most important of them all. But the other ones, I think they're just as important as each other. So they have the same importance. Okay, so don't let Vega affect you negatively. Pay attention to it. Don't ignore it. And always make sure that you have the Vega position that you want. So I hope that this lesson was understandable and that you got the gist of it and that you can apply it to your own trading so that you can be a better option trader. Thank you very much for your attention and goodbye.